Interest rates and home prices have gone up. We know that. And not only is it a question of affordability, but now it's also a buyer's discernment on whether or not that home or buying now is the right choice. Sellers are feeling this. They've been on the market for longer than we are used to. We got spoiled over the last couple of years, sellers did, with very quick turn times, very quick to go under contract. And so now, even though we're nowhere near normal with less than a month of inventory, it feels slow. So I wanted to propose a couple of alternatives and actually show the differences between those alternatives and options, both for a seller who's going to market and how do they want to list their home. And as a buyer, how can I strategize the best payment option for me right now? What is most important to me? Is it cash to close? Is it the monthly payment? Is it the adjustment period? And then do I expect in a recessionary period that interest rates will go down? Because I want to start here before I get into the matrix that I'm showing you. This is a little bit of a different video that we typically send out on Wednesdays because I want to give you a tool. This tool is clickable. You can actually open it up, rummage around, and look at the alternatives and request a strategy session so that we can set this up for your listing or for your specific buyer parameters. But I want to talk first, just for a second, on ARMs, because that option is not going to be described here. I'm going to go over going through and buying a home with 10% down, buying a home capitalizing on a 2-1 buy down, capitalizing on maybe a seller credit for a permanent buy down or a discount points to pay to reduce the rate, or should a seller have to reduce their price to get it to move? But what I don't show is ARMs, simply because there's 4 columns and not 5. So there you have it. But I do want to say that ARMs are going to work very similar. In fact, for the 2-1 buy down category, I used the model within this tool for an ARM. So we could switch this based on the kind of ARM that you're looking at, whether it's a 5-year, 7-year, 10-year ARM, and then what the parameters are for the movement of that ARM. The one risk that I want to present with ARMs that the 2-1 buy down protects you against is what if? What if rates don't go down? The third number on an ARM talks about what is the maximum that ARM can go up. And a lot of times it's got a 5 in it or a 4. So if today's interest rate for you for that ARM is 4.5, and that the last number on your ARM parameters is a 5, that means that that loan could go up to 9.5%. Would that wreck your budget? We're all counting on a recession and on lower interest rates, but do you need a plan B? So let's talk about these 4 options and consider a 2-1 buy down option instead of an ARM. They go hand in hand and they can trade out for one another. So if I were looking at purchasing or listing a home for $600,000, and as a buyer, I'm going to put 10% down. And as a seller, I'm going to consider my avatar, my buyer is going to put 10% down. So I'm talking to both buyers and sellers because this is a strategy to, one, attract buyers, to get people to come to your listings, and as a buyer to negotiate with a seller that might have been on the market a little bit and be open to negotiating, because not every home has been on the market more than a weekend. Some homes are still going with multiple bids and over asking. This is not a one size fits all, but it is options. Real estate is always about options. So let's look through these really quickly. And I highlighted some of these in yellow. So I just want to go through the purchase price. So we've got $600,000 until we get to the price reduction. So $600,000 is my model. Or a seller, if you've been on the market for more than a weekend, you might consider a price reduction. And in this case, we did a 3% price reduction. That is a dollar for dollar discount on your net revenues as a seller. So you just dropped the price, in this example, $18,000. I'm going to show you that that's not going to benefit the buyer that much. So the alternative is to either buy down their rate in a high interest rate market or do a 2-1 buy down. And as a buyer, you might want to negotiate this. So then let's look at the loan amounts. Obviously, we're looking at 10% down, so $540 across the board. That's the standard, except for this change, if I do a 3% price reduction and I'm putting 10% down, that loan amount now is $523 from the $582 list price. The interest rate on the standard market interest rate that I'm quoting today is 5.875 with 10% down. I could do the 2-1 buy down, which starts at 3.875. I could do a permanent buy down at 5.125, or going back to the 3% price reduction, that would be at the market interest rate. So now I just want to focus in on one of the programs really quickly. So you kind of understand the parameters by which we're working. Now let's dive in. So a standard $600,000 purchase price, 10% down. If we go through this column, we're looking at your standard loan scenario with 10% down. Maybe that buyer came in and offered right at ask, or this was something that was negotiated. It is $600,000. It is 10% down. The market rate of 5.875. Your payment is $38.36. That includes your PITI-MI. So you have mortgage insurance, principal, interest, taxes, and insurance, right? And then your cash to close is going to be just under $68,000, $67,681. Now let's hold on to that. So now let's go to the 2-1 buy down. So this is the program that I really like in today's market. The 2-1 buy down is the same. You might go in as a buyer, offer for a price, and ask for a 2-1 buy down. That will cost the seller just shy in this scenario of $12,000. The cost to the seller is the difference in the monthly payment with an interest rate 2% lower for the first year, 1% lower for the second year, and then you go back to a 30-year fixed. This is why I like a 2-1 buy down compared to an ARM, because 1 year I get a 2% lower rate. The second year I get a 1% lower rate. The third year and thereon, I'm locked in a 30-year fixed at 5.875. This protects my downside. If rates don't go down and if a recession doesn't happen the way we expect, I have a plan B in place. That rate will never go higher than 5.875. So if I take a look at this, I scroll down and I look at the payment stream, you'll see that my first, and this is just a principal and interest, my first payment for the first year is 3.875. My payment for the second year is based on a 4.875. And then my payments thereafter are locked in at the 5.875. That gives me a savings personally as a buyer of $655 a month for the first year, $345 a month for the second year. I now can move. I now can maybe buy that home that I was really wanting to buy, but I couldn't because the monthly payment was a little high given the interest rates. And maybe I am counting on the interest rates going down during a recession and I want to refinance it. But worst case scenario, I can budget based on the expectation of raises or based on my spouse who might be staying at home with the child, but now is coming back to work, or whatever your circumstances are. That monthly payment at that market rate, I can live with. I can do that. I just prefer, and I need an adjustment period. That's what that 2-1 buy down is going to give you. The seller in turn is going to pay that. That is going to be a seller credit to buy down that rate. It's going to cost the seller about just under $12,000 in this scenario. So that's going to be a straight savings to the buyer. That monthly savings, as I mentioned, is $655 the first month. That first month's payment is the $31.81, that 3.875. Now, if I look at cash to close, I'm looking at the same cash to close between the $600,000 10% down and this 2-1 buy down, because that is typically a seller pay. It's a negotiation. So let's compare this to the permanent buy down, because I was a big fan. In fact, when the 2-1s first came out, I was like, why wouldn't somebody do a permanent buy down? Why would I temporarily do it? Well, it doesn't. Your money doesn't go as far with a permanent buy down. Your money simply doesn't go as far. If you need a lower interest rate to qualify, you will need a permanent buy down, because the 2-1 buy down is going to qualify you at the higher permanent interest rate. But a permanent buy down means I'm going to take maybe that same amount of money that I was going to take as a seller credit, just under $12,000, and instead I'm going to apply it all to a permanent buy down situation. I'm going to drop my rate right here to 5.125 based on the market and based on taking that same amount of money for the 2-1 buy down to a permanent buy down. Well, that saves me, the mortgage payment on that is $35.82. compared to $38.36. So that's saving me about $254. And you can see that over here on the right side, the monthly payment difference between the 2-1 buy down, the permanent buy down. And then the monthly payment on this last scenario, the 3% down, while the loan amount looks lower, my cash to close isn't that much lower because I'm only putting 10% down. And my payment really isn't that much lower. Between this $37.29 and this $38.36, it's only about $100 difference. So that price reduction as a seller, you think this is going to be the thing that's going to woo my buyer in. It really doesn't mean as much to the buyer. Yet you spent upwards of $6,000 more to do a price reduction than you would have, whether it was a permanent buy down, a discount, or a 2-1 buy down. So looking at the savings over 60 months, this is a little bit higher, the 2-1 buy down, because I did have to use the ARM strategy, and the ARM strategy is recalculated based on each year. This is a 30-year fix, the 2-1 buy down is. So it looks a little bit higher. So that savings over 60 months for the 2-1 buy down is really just going to be that upfront cost, just under $12,000. But it's still more over the next 5 years than the permanent buy down, which that savings to a buyer is only $8,000 or $4,600 for the 3% price reduction. So you can see the advantage. And especially if we think interest rates are going to go down, you're going to be able to lock that loan in at a lower interest rate and refinance with using our $1,000 refinance certificates, which I hope you're getting one. Once you purchase with us, we'll give you one of those. So this is the strategies that we're talking about, this and ARMs and 100% physician loans and 8-day closings and pre-approvals and all the things that the Rueth team does and does well. We want to also present it with the financial strategy of what is the best solution for you right now. How do we get you into the home so that you can start building the financial stability and security and success for all of your futures? Because we know rent might be cheaper today, but buying secures your financial future. So how can I and the Rueth team support your decision today? So maybe it's a little less of a difference. Maybe it fits your budget a little bit better. And maybe you get into the home of your dreams at a lower monthly payment. Well, I would love to talk to you further, set up a strategy. We have all of our information. Please take some time, click away on this model. If you have any questions, you want a specific one for your listing, or you want a specific one for your buyer strategy, I want to support you. It's always my pleasure, and I hope to talk to you very soon.